John, listener questions.
Yes, we got a bunch of them.
We do. They have been piling up. You know, we've been doing an inbox episode every Thursday where we answer a listener's question, and we thought, well, this will be a good way to stay on top of it. You know, where we didn't run into the issue that we ran into last summer where, I mean, we spent almost all summer with just episodes answering listener questions.
Right.
It wasn't enough.
Yeah, no. One episode a week.
Yeah.
Doing one listener question or maybe two.
And it's funny because in these questions, we will often, I sent an episode to the editor the other day and it was 13 minutes and we're answering one question.
Right.
For 13 minutes.
Yeah. Well, we're both a little long-winded.
We like to be thorough.
That's right. With thorough.
So
go with that.
After looking through all of the questions that we have pending, I thought, you know what? We need to take some of the weight off, and we need to trim a few questions out of there, and let's just do an episode where we do nothing but answer listener questions.
Yep. I think that's a good one.
So we're going to jump in here.
Yep.
Let's get some of these questions answered, and let's kick it off with Amy. And I like this question because it leads into some very recent news that we've had. Amy said, if there is no tax on Social Security, will the IRMAA calculation exclude the Social Security income? Well, there's two answers here. Number one is that presumably, yes, if Social Security was not taxable income, it's not going to be included in adjusted gross income. Therefore, it would not be included in the calculation that they calculate IRMAA by. However, unfortunately, yesterday, or maybe day before at this point, and this is as of the time we're recording this, not when our listeners are listening to this.
Yeah, which may be a week or two.
Yeah, maybe. The big beautiful bill, the one beautiful, whatever it's called.
Yes.
The Trump tax bill came out, and guess what was not in it? The elimination of taxes on Social Security.
So that may be a pipe dream anyway.
Yeah. Now, I do not know all the intricacies of how legislation works. I leave that to you attorneys. But from what I read, you can't make big fundamental changes to the Social Security Act through the budget reconciliation process, and therefore that's why it was not included. I don't know.
I know the old saying that if you like law or sausage, don't watch either one be made.
Here's what I do know, though, John. This may be a little salve in the wound here. And we will likely do, as this moves closer to becoming final legislation, we'll likely do an episode or maybe a series of episodes on, I don't know. I'm somewhat hesitant to say that we're going to do a series of episodes again after the estate planning series, which was fantastic.
Well, but I do think if there are major law changes, which it looks like that there are some,
absolutely,
there are certainly some coming on the horizon. It's very likely that we'll end up at least having to cover the changes to the death tax, if any.
Yeah.
Changes to Social Security and taxation related to that, if any.
Yeah.
Changes to the Medicaid rules, because I just got an alert this morning as we're recording this on some proposals that have come out of the House on that. So, I mean, it very well may be.
Yep, it could be. But one of the changes that was proposed, that who knows if it's going to make it into the final legislation by the time they put it on the cutting room floor and everything, is a senior bonus deduction. And this, right now, if you're over the age of 65 and or blind, you get an additional amount added to the standard deduction.
Right.
So in 2025, the standard deduction for an individual, I believe, is $15,000, and an additional $1,550 if you're over the age of 65. And another $1,550 if you're also blind. All right, so roughly for married filing jointly, what does that put us? Is that?
I don't know.
Yeah, I'm not going to try to add it up either. Anyway, the new senior bonus is going to be an additional $4,000 per person.
Okay.
If you're over the age of 65 and under certain income limits. So for married filing jointly, that would be an additional $8,000 standard deduction on top of the regular standard deduction, on top of the age 65 standard deduction, so an extra $8,000 if your modified adjusted gross income is below $150,000.
Gotcha.
So that's one piece that is there. And I would think that there's a pretty high likelihood of that actually making it through because it doesn't benefit the rich, and
Right.
those are the things that's likely going to come under a lot of scrutiny. So, Amy, unfortunately, I don't think this is going to happen with no tax on Social Security, at least now.
That's right.
It likely won't. All right, John, the next question is from Mike. And Mike said, we have a main home worth $500,000 and a lake house worth $600,000. Thinking about redoing our will with a trust after listening to y'all's podcast. And he said, y'all. So I bet he said, y'all. So he is either low-key making fun of us.
Distinct possibility.
Or he is in the South. I'm not sure which. Mike, you'll have to tell us. All right. We have decided to sell the lake house and put some of the money into making our primary home more mobility friendly. Our CPA has told us that if we put the lake house in a trust before we sell it, we would lose the living there the last 2 of the 5 deduction to avoid capital gains. So he's talking about the exclusion of capital gains on a residence. So the question is, 1, is this accurate? And 2, should we wait till we sell it to address our estate plan? Thanks for all you do. Okay. So, John, it looks like Mike is getting ready to have his estate planning redone. He's having a trust drafted, and he's thinking about putting the lake home in the trust, but he's going to sell it, and he doesn't want to pay capital gains on the lake home. Now, I'm going to let you put your lawyer spin on that.
Well, so this is Section 121 of the Internal Revenue Code, which says that if you've resided in a home for 2 of the previous 5 years, then you can exclude up to $250,000 of the gain for a single person, $500,000 of the gain. And notice I'm saying the gain. Right. It's not the sales price. It's the gain on the sale. And so his question is basically, okay, we'll assume that he meets the 2 out of the 5 year on the lake house, right? Because he does have 2 houses here.
That's right. And I think that's something worth discussing.
So you have to have the 2 out of the last 5 years. So I'm going to assume that they can at least meet that test. Yeah. Right. And so his question is, well, if we change the ownership from ourselves to a trust and then sell the house, would we still do you get to carry over your residency, right? Yeah. So I've lived there for 2 years, let's say, and then I transfer the house to a trust, and then a week later I sell it. Do I still get to consider it the fact that I've lived there for 2 of the last 5 years? The short answer is yes. You can still treat it as a sale under Section 121. Now, I say the general rule. So he says the word trust, and as we've talked about, saying the word trust, like saying the word surgery, there's lots of different types. What I'm assuming he's talking about would be your basic estate planning trust, so your revocable living trust type deal. Those are taxed as a grantor trust. They're a totally disregarded entity for IRS purposes. And so transferring a house into a revocable trust is going to have no effect on Section 121. You would be able to turn around and sell it. That is also true generally for just about any grantor trust for income tax purposes. Yeah. As long as the trust itself allows you to continue to use and occupy the residence. Right. Now, if you transferred it to a trust that was for the benefit of your kid and you were not a beneficiary of that trust in any way, shape, or form, probably not. But that's not. I'm sure that's not what he's talking about. Yeah. What he's talking about is either a revocable trust or an irrevocable trust that they're still the grantors of and would still have use and access of the property. So yeah, he can sell it, still get to Section 121. Now here's my one caveat to this, because his second question is, should we wait to sell it to address our estate plan? Time frame. If you're planning on putting that thing on the market in the next couple of weeks, and it's a lake house and it's a hot market, and you figure you're going to have 200 offers in the first 3 weeks that it goes on the market, and you're just going to be able to pick the highest one and it's going to close 6 weeks later, yeah, just leave that alone.
Yeah.
Don't create another title issue in there that might delay the closing. If, on the other hand, you're considering selling the lake house, you might sell it in 6 months or a year. Go ahead and get it done.
Yep.
No question.
Yeah. Now, I do think that we need to revisit the issue of having 2 homes here, though, because I get it, right? If you have 2 homes, and let's say you have a large capital gain on both,
Yes.
as is the case right now for just about anyone who has 2 homes that have owned those 2 homes for a number of years because of what real estate prices have done. I understand that it's tempting to want to evade the capital gains. And maybe I shouldn't use the word evade because that sounds like a
Avoid.
Yes, avoid. All right.
Yeah, you know the difference between tax avoidance and tax evasion?
20 years.
20 years.
Okay. So I understand that you want to avoid the capital gains on both of those properties.
Yes.
And I've yet to personally experience this. My understanding is that the IRS, when they are digging into this, if they dig into this.
If they dig into it.
Right. You have to meet the use test, right? Which is 24 out of the last 60 months. You had to have resided there, right?
Correct.
Owned it for that period.
As your primary residence.
Yes, as your primary residence. Now, the question always comes up with like, yeah, but how do they know what my primary residence is? Because I'm saying that's where we've lived. Okay, where's your driver's license? What address is on your driver's license?
Yeah, where are you registered to vote?
Yeah. What about the other family members in your house? So for example, I have a home in Missouri, right? I have a Texas driver's license. I'm registered to vote in Bowie County, Texas.
You have a business in Texarkana,
right.
Texas.
So for me to make the claim that, yeah, this was my primary residence for 2 out of the last 4 years, and then I moved back to Texarkana, and served 2 out of the last 5. Did I say 2 out of the last 4? I think I did. 2 out of the last 5. Then Texarkana, and we sold that house, and we got exclusion of capital gains on both. That very well may work.
As long as you can prove it.
But it may not.
Long as you can prove it.
Because if they come back and they start asking for some evidence that was my primary residence in Missouri, I'm out of luck.
Yes.
I'm out of luck. I've got utility bills, but as far as the IRS knows, that was a rental property.
Yep. That's that same issue comes up in Texarkana pretty routinely. So Arkansas has a state income tax, but the city of Texarkana, Arkansas, because it borders with the state of Texas, has an exemption from Arkansas income tax. So if you're a resident of Texarkana, Arkansas, you're exempt from Arkansas income tax. There are a lot of people in the state of Arkansas who own property in Texarkana, Arkansas.
Yes.
And they claim as their primary residence for purposes of avoiding the Arkansas income tax. But there are several cases where the Arkansas Department of Finance has looked into that and challenged it. And everything that you just pointed out are the same kind of things they look at.
Yeah.
Okay, well, you have a house in Fayetteville and you have a house in Texarkana, Arkansas, and those are 6 hours away from each other. Where are you registered to vote? What does your driver's license say? What is your occupation? All of those are factors that they would be looking at.
Yeah, yep. And that's, with this, I still hear that quite a bit from people here in our town. And I would say that, the State Department of Revenue here has a long reach. It's not the reach of the IRS, though. And so when,
right.
that's a good comparison for sure. But still,
yes.
If they come after you, it's serious. But if the IRS comes after you and says, no, this didn't happen.
Yeah. And basically the way that happens is you get audited.
Yeah.
And if you get audited, then during that audit of that tax return, they're going to ask you to prove that you qualified for that exemption.
Yeah.
And you need to be prepared to prove that.
Perfect. All right, John, I'm going to let you take the next question. This is an estate planning question from Michael.
Okay. Let's see. Michael says, I am listening to your perfect estate plan episodes, and I'm wondering how taxes will be paid if I have beneficiaries listed on all my assets. My state, Pennsylvania, has an inheritance tax, which will need to be paid within 3 months of death to get the discounted rate. And I think, so basically, like, there's a state inheritance tax, and if you pay it within a certain period of time, you get maybe a discount. I'm not familiar with Pennsylvania on that particular issue. And I didn't, and because everybody knows how much preparation we do for these, I'm reading this now for the first time.
Okay.
So I didn't prep for it either. Will need to be paid within 3 months date of death to get the discounted rate. My estate will not be subject to federal estate tax, so he's not in the 14 million range. Can I put beneficiaries on all my accounts, or should I leave some to the, quote, estate of, to make sure there is enough available to pay that tax? Or can that money legitimately come out of the executor's inheritance that was passed via beneficiary? So, again, because I don't know Pennsylvania directly, I'm going to talk about it from the federal perspective, because I'm going to assume that it's going to be very, very close.
I'll bet. Yeah.
But to use a real simple example, again, the federal exemption is $14 million as we record this, $13,990,000, but 14 million. So let's just say I've got a $15 million CD at the bank.
Yes.
Right? That's the only thing I have in the whole world.
That's it.
And I've named you, Devin, as the beneficiary on that.
Right.
Right? So I die, bam, that's yours.
All I need is a death certificate for John K. Ross, and I get the $15 million.
Now, the federal estate tax is paid by the estate of. So John Ross's estate owes this money, but it's gone to you automatically.
Right.
So my estate is basically empty. Well, the laws are really clear on that. Basically, you're getting it subject to any death tax that is owed by my estate.
Yeah.
So to his, so he says, can I put beneficiaries on all my accounts? Yes. Those beneficiaries are going to be required to pay, to give some of that money back.
Yeah.
To pay the inheritance tax. As long as they're all willing to do that, because if they don't, they're going to have personal issues, right? State of Pennsylvania is going to come after them personally. So yes, you can do that. Your question of, or should I leave some to the estate of? Well, the problem there is if you leave it to the estate of, that's going to go to your probate estate. And he's listening to the perfect estate plan. And if he's gotten to the part of non-probate transfers, then we talked about the probate process. I'm not sure, based on where he is in Pennsylvania and their court backlogs and whatnot, that they could get somebody into a position as court-appointed administrator or executor within the 3-month time frame to be able to access the accounts that are payable to the estate of.
Yeah.
It may not happen. So I don't think that's the answer. But I do have a couple of suggestions. So one, he's talking about naming beneficiaries on everything. And while that's fine, if alternatively he was using something like a revocable trust, and he even if all that had was just a few bank accounts, right? A CD at the bank that's in a revocable trust. Well, that money then, as soon as he dies, his successor trustee would be in control of it. They could pay that, use that money to pay the taxes, and then distribute whatever's left. That would still be a non-probate transfer. That wouldn't have to be any sort of really fancy trust, because you're just using it for that one event.
Right.
And that's using something like a revocable trust. Or, I don't know what Michael's net worth is, but he's got at least a little bit of money. The more money he has, the greater his Pennsylvania tax bill is going to be, I would assume. It might make sense to create an irrevocable trust. And let's say he's got 3 kids. He could create an irrevocable trust for the benefit of the 3 kids. And each year he could make a gift to that trust of $19,000 per beneficiary. So 19,000 times 3, and he can put that into that irrevocable trust. Now we're going to do two things. One, we're reducing the value of his estate.
Mm-hmm.
That's less money that's going to have to be, that taxes are going to have to be paid on.
Right.
Right? For if whatever the tax rate is, if it's 5%, then you're
Yeah.
saving 5% of every dollar that goes into that irrevocable trust.
Right.
Period. End of story. And now you have this bucket of money that can be used to pay the taxes.
Mm-hmm.
So I think the real answer to Michael's question, if he's got the resources to be able to make some lifetime gifts, would be create an irrevocable gifting trust, a type of trust that where you can make gifts to the beneficiaries of the trust and keep those out of your estate. That reduces your taxable estate
Yeah.
and provides the liquidity to pay the tax.
Very interesting. Now, I want to ask the question that I would imagine that some of our listeners have. Let's go back to the federal estate tax example for a moment. And John, let's say that you leave $15 million to me and my brother.
Mm-hmm.
Okay? Now you have roughly a $500,000 estate tax due because you've died, right? That very roughly speaking.
Okay.
So I'm willing to pay my part. My brother says, heck no,
Uh-huh.
I'm not doing that. What happens then?
Well, if the bill doesn't get paid, the beneficiaries are going to be jointly and severably liable for the tax.
Wow.
Which means what you don't get to do is throw up half the money and say, well, I'm done. I've done my part.
Yeah. Oh, wow.
Because, again, if the bill is $1 million and you say, well, here's my 500,000,
Yeah.
so I'm out.
Yeah.
No.
Yeah.
That's not how that works. The IRS can, for the remaining 500, can come after both of you equally.
Whew.
And you could make a claim against your brother, but that's separate. That does not change your liability to the IRS.
Nice.
And it's probably the same thing here with Matt and related to his Pennsylvania tax.
So the short version is, if you think you're going to be subject to the estate tax, you need to put some provisions in place to pay that tax and not just have everything non-probate transferred.
Yeah.
direct to
So
beneficiaries.
again, I think having beneficiaries on everything is fine. But what I would really suggest in this case would be, maybe run some calculations. And I just Googled it, and it looks like the tax is 4.5% for transfers to direct descendants. Okay. 12% for transfers to siblings, and it goes on from there. But so, okay, 4.5%. So add up the value of your estate, multiply it by 4.5%, figure out what that number is. Now set up an irrevocable trust and start putting some money in it.
Yeah.
And you're going to say 4.5% of every dollar you put in there, and your goal being to put as much in there as you expect there to be a liability.
Interesting.
Or more, right? At least as much. If
For
you,
sure.
If
Right.
you think the tax bill is going to be $50,000, then your goal is to put $50,000 in there. But if you have the ability, keep putting money in there.
Oh, for sure. Because for every dollar you're putting in, you're avoiding that 4.5% estate tax, right?
That's right.
Yeah.
Absolutely.
Yeah. Perfect. All right.
So what's that bring us up to, Amy?
Amy's question. We've already had an Amy. We've had two Amy's today. Okay. Amy said, I'm hearing that in Oklahoma you can do a deed for a piece of property and put a transfer on death on the deed, which would be my only child. So my question is, when I die, will my child get a step up in basis, which would be at the time of my death? So effectively, she's saying, hey, with this transfer on death deed, give my child a step up.
Yes. Moving on.
Very simple. Next question.
Real short answer is, if assets are included in your gross estate for federal estate tax purposes,
Yeah.
then you get a step up in basis. So if you have a home that you have the right to live in, which with a transfer on death deed, you're not changing anything about the house.
Absolutely.
It's your house. You're just saying, here's who gets it when I die.
Yeah.
And so just like having a CD at the bank where you have named beneficiaries on it, or a stock at your brokerage account where you have named beneficiaries, that transfer on death deed is going to pass automatically to the beneficiary by beneficiary designation. Nice and simple, easy way to create a non-probate transfer, because You have the right to own it and occupy it during your lifetime. Section 2036 of the Internal Revenue Code would pull that into your gross estate. There's not any tax due because unless that's a $14 million house, we don't have to worry about the actual death tax, but that would give you the step up in basis.
Yep. So it doesn't change it.
Doesn't change it.
All right, Amy. Hope that answered your question.
Easy breezy.
Next is Tony. Tony said, I'm 62 this year and considering selling a second home in a few years. That's the second question we've got today about selling a second home. I want to know the effect of the home sale capital gain on IRMAA and Roth conversions as in my calculation. So he's wanting to know, hey, is this going to drive me up for my adjusted gross income for purposes of Roth conversions and for the income-related monthly adjustment amount for the increase in Part B and D Medicare premiums? And John, the answer to that, and you may be able to expand on this, but the answer to that is absolutely yes. Yep, it's going to drive you up. That capital gain is certainly going to impact your modified adjusted gross income for the IRMAA, and it's going to drive you up into the higher brackets when they're looking at your taxable income, to determine, all right, now if on top of all of this, you convert $100,000 of your IRA to a Roth, all of that stuff is going to, lift the boat up a little higher and subject you to potentially a higher rate.
Yeah. So do what Mike is doing and go live in the dang place for 2 years and change your ID and register to vote over there and do that for 2 years, then sell it.
Yes.
And get the Section 121 exclusion.
Absolutely. All right. Rick said, I hear all the time that at age 65, if you're not on employer-sponsored health plan with 20 or more employees, that you must go on Medicare. I know it would be foolish not to and would be financial suicide. But my question is, are you legally required to? So what Rick is asking about here is the creditable coverage, right? So if you're 65 and you don't have creditable coverage, which is generally you work at a place of employment that has 20 or more employees and they have healthcare coverage, if that's not you, you have to go on Medicare. But his question is not just should you,
but do you have to?
Do you have to?
Or could I just give him the finger?
Yeah, that's right.
I ain't doing it.
That's right. Forget you. Yes, you could, Rick.
Rick's like old Red sitting on his porch with his shotgun.
Right. You absolutely are not legally required to go on Medicare at any age.
No, you don't have to do it.
They are not going to come pick you up and take you down to the county jail because you failed to file for Medicare.
Right. Yeah. What you are going to do is that if you ever do get on Medicare, you're going to pay a significant premium adjustment penalty.
Yes, you are. And I believe it's 10% per year.
Yes.
That you delayed.
Yeah.
And so, no, you're not legally required to, but would it be smart to? Absolutely. And Rick even acknowledges it here.
Yeah, he said it would be foolish not to and would be financial suicide. But my question is it legally required? No.
Yeah.
You are perfectly free to...
It's kind of like the guy that came to me one time, and he was 72 or 73 and hadn't filed for Social Security yet. And he was just kind of a stick in the mud. He goes, well, I don't have to.
You're right.
It took me a minute to wrap my head around that, right? No, you don't have to, but you've missed out on 3 years of benefits too.
Right.
Because your benefit is no longer increasing, at least by virtue of delaying it. So why would you?
Right.
Same thing here. There would be no reason to do that.
Yeah.
All right, Rick. Another simple, easy answer. Larry's question is a little bit longer.
We can probably summarize it a little bit.
I think we're going to need to. That's.
But he says, he's been
quite
listening.
the paper.
He's been listening for a while now, and he's getting some great insights into trusts.
Mm-hmm.
And Larry looks like they're kind of a off the grid.
Yeah,
type,
I think they may be
folks.
some preppers.
No debt. They got the house. They got some cash, not in the bank.
Yeah, no, he specifically said cash saved, not in bank.
Some precious metals, which I probably assume they're holding the actual metals themselves.
If the cash isn't in the bank, I'll bet they are.
Yeah, they got some other miscellaneous equipment and vehicles and such. Not wanting to invest or anything. Not considering wealth preservation. They got no heirs. They don't care about any of that. They got some income and great health care, although they're concerned about their income and their health care because of potential issues with the government. They're in their 60s. Looking for your opinion regarding trusts and so forth, understanding that privacy, self-direction are of utmost importance to us. So all of this basically kind of going back to, can you use trusts or other estate planning to create some anonymity out there? And the short answer is yes, you can. For example, from a very basic example, one question I've started asking people routinely, like, Devin, if you came in to my office today and said, I want to talk about some estate planning, and we decided to set up a trust for you, one of the first questions I'm going to now ask you is, what do you want to name the trust? Mm-hmm. Historically, I might have just called it the Devin and Karen Carroll Living Trust. In fact, I think that's exactly what yours is.
Yeah,
right?
Very close.
But now I would ask you, I was like, would you like to name it something that's not your name? Mm-hmm. You know, the DKC Trust or something, right? Just so that if you're titling real estate, for example, in the name of the trust, and somebody's looking on the public records,
right?
Well, they see the name of the trust, but they don't see who the beneficiaries are. They don't necessarily know who the trustees are. And so you've created some anonymity there. So you can use trusts to create some anonymity out there by just by using a different name on the title of the trust. You can also do some combinations in this where you've got some business entity structuring. I have a lot of clients that use Wyoming as the situs for creating something like an LLC. They'll create what Wyoming calls a close LLC, which is generally a family-owned LLC. So it's husband and wife, and they do that in Wyoming because the Wyoming is very very strict about what information is disclosed out there. And so the short answer to his question is yes, you can use if privacy is very important, then using trust planning and or some business entity planning may make a lot of sense. It's not going to be quite, if somebody wants to find it hard enough, they're going to find it. But it's not going to be easy.
You can't become invisible completely.
That's right. But it's not, but you are going to make it difficult. And usually that difficult is enough for what he's concerned about.
Yeah, perfect. All right. So, Larry, I hope that answered your question, and best of luck to you in these investments and the endeavors at maintaining your privacy. It's becoming harder and harder, for sure. Marcus asked, he said, you often talk about the probate process being timely, complex, and expensive in some states. Could you provide a ranking of states from easiest, and thus where a will is probably fine, to the hardest, where a trust is almost always the way to go? I understand this would be situation specific. How about if we assume a non-blended husband and wife with 2 adult children with special needs, without special needs, drug habits, etc., both of who are financially responsible and independent and living a normal middle-class lifestyle? You know, John, that goes back to something that we talked about in our estate planning series, where you said, don't plan for what you hope happens, plan for what could happen.
That's right.
Right? And we talked about recency bias, because there's no special needs, drug habits, there's financial responsibility, and they're living a normal middle-class lifestyle now.
Today.
Right.
Right? Not tomorrow.
Yeah. So in terms of the ranking of states, I have no idea.
Well, I asked ChatGPT.
Yes. Okay, good.
So take that for what it's worth. But I asked ChatGPT to rank the states for me, and it did not rank all 50 states. But what it did give me was basically the worst and the best, according to ChatGPT. And the key takeaways from ChatGPT, states like California, New York, and Florida. And I will say, I have heard those 3 repeated over and over throughout the years. You know, I just got back from Seattle. I was at the National Academy of Elder Law Attorney annual conference. And you've got attorneys from all over the country that practice in this area at that conference. And those 3 states come up routinely as having burdensome probate processes. And then it says, again, ChatGPT, back to ChatGPT, states like Alaska, South Dakota, and Wyoming are more probate friendly with simplified procedures and lower costs. And that also seems on brand. I know nothing about those 3 states, except all 3 of those states have been on the cutting edge of asset protection trust planning, LLC, anonymity. And part of that is because they keep their costs low. They have very low, you can form an LLC in Wyoming for, it's like $100 or something like that, $150. It's relatively inexpensive. If that carries through to their probate process, I hear the Texas attorneys all the time talk about, well, Texas has a relatively simplified probate procedure. Yeah, okay, sort of, it does. You know what the filing fee to probate a will is in Texas? It's over $400 now. It's like $427. That's just to pay the court to start the process.
Right.
That doesn't count what the newspapers charge to publish the notice. Most of the newspapers, the print newspapers, the only reason they're still in business is because you have mandatory, statutorily required publications that have to happen, which means they can charge whatever they want.
Yep. Right.
I mean, what else are you going to do?
Yeah.
The statute says once you probate this will, you have to publish notice in the newspaper. Well, the newspaper can charge whatever the heck they want for that, right? And again, even in our small community, you're talking over $200.
Wow.
So right there, you're at $600, $700 in filing fees and newspaper costs. You haven't paid an attorney to do any of that. You have and all of that. It still takes time. Maybe it doesn't take as much time, but it still takes time. And so I would still, even in a place where it's more probate friendly, that does not actually change my general position that you should avoid the necessity of probate. And so what was our guy's name here? I got to go back to that tab. Was this Marcus? Yeah.
It was Marcus.
Yeah. So Marcus, even if we're going to go with your, what'd you call it? Recency bias?
Yes.
Yeah. Even if we're going to go with your recency bias and assume that all the kids are perfectly good and they're going to be in the future.
Absolutely.
They're all going to be alive. They're all going to be well married. They're all going to be healthy. None of them are going to have any creditors or debts or any of that sort of stuff. It's going to be perfect Ward and June Cleaver. Yes. Right? So we're going to assume all of that. Then just name everybody as beneficiaries on everything.
Right.
Including do something like a transfer on death deed on the house. Still avoid the probate process. Just, you don't, I use trusts a lot because they're a comprehensive vehicle, but that's not the only way to avoid the probate process.
Yeah.
So I would still put beneficiaries on everything, do all those things, kind of like what our earlier question from Amy on, she lives in Oklahoma. Sounds like the only thing she's got is a house and she's going to leave it to a child, so she's going to name that child as a beneficiary. Now, let's say Oklahoma has the easiest probate process in the whole world. It's still not as easy as doing a transfer on death.
Right. Absolutely not. Nope. Never will be.
So the real answer to Marcus's question is it doesn't matter.
Right.
The only thing that matters is how you're going to do your probate avoidance planning.
Yeah.
Are you going to do it with, say, beneficiary deeds? Are you going to do it with something like a trust? But do your probate avoidance regardless. Yeah. And then if you live in a place like New York, California, Florida, where it really is a known situation, then you probably want to be particularly careful in your non-probate planning.
Right. Yeah. Perfect. Well, I think we have time for one more question.
Yeah, I'd say so.
And let's take this one from Rochelle. Rochelle said, when I die and my child inherits my IRAs, can she do Roth IRA conversions after paying RMDs each year and put that money into my Roth IRA? I know she has to take both out within 10 years of my death, but if she can do this, seems like it could still give her years of income with no tax on the Roth IRA conversion. Now that I read back through this question, I think Rochelle may be asking a question that is different from what I thought she was asking initially when I just read over this a moment ago. Can she do Roth IRA conversions after paying RMDs.
So what I'm gathering here is that Rochelle has traditional IRA and Roth IRA.
Mm-hmm.
And she's got her daughter listed as the beneficiary, or child listed as the beneficiary on both. So Rochelle dies. Child now has an inherited traditional IRA and an inherited Roth IRA. And then her question is, could she convert some of the traditional inherited IRA into the inherited Roth IRA?
Yeah, gotcha. Okay, so it's fundamentally the same question. Can you inherit or can you convert an inherited IRA?
Right.
And the answer to that is no.
Right. Yeah. Simple enough.
Cannot.
Nope.
Yeah. No, you cannot. You could take those distributions, pay tax on those, and then make a contribution to your own Roth IRA, but you're not going to be making contributions to an inherited IRA.
Yeah.
Not going to be happening.
And I don't know that even if you could, under her question, I'm not sure that there's a situation where that would make sense anyway.
No. Yeah. And there's really no to even go down that road because you can't, right? It's just not going to happen.
But yeah, short answer is no.
Yeah.
You can't do it. It was a nice try.
Yes.
I like anybody who
Oh, I do too.
who gives some creative planning the old college try.
Yes. I like that.
Even though most of the time that has already been answered out there in the wild.
It has. Very good. Well, John, let's wind it up right there.
Sounds
and
good.
Listeners, if you have a question, bigpictureretirement.com, up in the top right-hand bar, it says Ask a Question, and you can leave us your question there. And John, we still have some other questions to get through, but I think maybe we can tackle all of these by doing inbox episodes from this point forward. We'll see.
Unless I mean, this is obviously a popular thing because people keep asking questions. So
Yeah.
who knows? We may be this may be a Cobra effect sort of thing, right? Where it's like, okay, well, we're going to do a whole episode on listener questions to catch up on listener questions, only for that to incite the listeners to ask more questions.
Absolutely.
And then we just further the problem. But who knows? But we have a lot of listeners, which is pretty cool. And I bet a lot of them are subscribed on iTunes or Spotify or whatever service. If they've gotten used to listening, they may not be checking out the fact that we're doing this on video.
Yeah, they may not. We've turned the cameras on.
Yeah.
And you can see all of this stuff.
Yes, in all of its glory. But it'd be cool because I know you always are like, hey, give us reviews, give us some likes. If you haven't done it, swing over to YouTube, hit the subscribe button.
Absolutely. Big Picture Retirement. You'll be able to find us there.
Yeah.
Very recognizable. There's nothing fancy about the channel. The editing is very simple. It's literally a recording of us talking.
Yep. But between, in the world of trying to get this information out there to the people, YouTube has a broader reach.
They certainly do.
Than the podcast world. And so when you go out there and you click that subscribe button on YouTube, that tells their little demons in the system that more people need to be shown this when they're scrolling around.
For sure.
So hey, we appreciate the likes.
Yes.
We love all of those. We love the listener questions. But now get over onto YouTube as well and click that little button too.
We were just talking about this before we started recording today, and we said, just based on some of the very, very early data, if we project that out, there's going to come a time where YouTube is going to be the larger platform for our podcast.
Yeah.
I don't know how long that's going to take, but it's coming.
But everybody that's listening right now could be a part of making it happen.
Absolutely. You can say you are one of the first subscribers.
That's right.
Very good. All right. Well, thank you all so much for listening.